Again, with the market, stocks are lower on political concerns in Italy, and now the new worry for investors here at home. The banks, the XLF dropping below its 200-day moving average. A good part of that could be because of what Morgan Stanley just said at a conference. That stock having its worst day in a couple of months. Wilfred Frost with us at the desk today with those details. It's good to see you. All right, already jittery market, we know. Yields over in Europe, a big story. And then this gentleman, the co-head of wealth management, makes some comments that sort of unnerve bank investors yet again.
Yeah, but I think we'll come to the Morgan Stanley comments at the end, because US banks opened lower and they've continued to sell off through the day. And this, of course, started with the story in Europe. If we look at a half screen with some banks around Europe, you can see that Italian banks are down sharply today. German banks down sharply, French banks down sharply. Now, US banks also down sharply. Now, why is that? Even if they're not got big exposure to Italy. Yes, the concerns in Italy have seen yields spike in the Italian bond market, but if we also look at bond markets in safe haven bond trade, like Germany, like the US, we'll see that we've moved the other way. Yield curve has flattened, it's fallen. The 10-year in the US moving sharply lower. So that has affected banks more broadly from the start of today's trade. Now, if we move on to Morgan Stanley, the head of wealth management, two main things he's saying. One is that there's a bit of pricing in their deposit pressure within wealth management. Wealth management's been a big driver for them over the last year or two, so maybe that's not going to be as pretty as it's been in the past quarters. He also talked about lowered transaction revenue during the quarter, particularly March continuing this quarter, whereas the strength came January and February last quarter, and that's infecting, thoughts of trading revenue. But this is broadly a yield story that started this morning.
Just sort of accentuates the point that, the investors, like the folks around this desk, continue to look for bright signs in the banks and reasons to buy bank stocks. All of you don't want a headline of transactional revenue questions of a bank like Morgan Stanley, where here we're watching all the banks sell off and at the lows of the day as we're having this conversation.
Well, this is the wealth management co-head. He was talking about transactional revenues within wealth management.
Sure.
I've seen a couple of flashes on the wires extrapolating that to trading revenues across all of the investment banking. That's not quite the same thing. So again, on a day when banks are already selling off, perhaps there's a little bit of an overreaction to the Morgan Stanley headlines anyway. But the vast majority of the move today is not that Morgan Stanley conference performance. It's what's happened to bond markets globally. Safe havens have seen yields
You have to be living. You have to have been living on Mars to think that there was a future for transaction-based revenue within Wall Street wealth management. Literally, what planet do you have to have been watching the state of the industry to think that the whole thing's not going to be fee-based within the next 2 or 3 years? To me, that's not shocking at all, and I agree with Wilfred. That is not what's driving large-cap U.S. banks today.
To talk about European banks as well, which is clearly
it's a good point, right? Because I wanted to point out that European bank stocks are having their worst day in a year and a half.
They are falling sharply for two reasons. One is they do all hold quite a lot of Italian debt. That's the third biggest bond market in the world, and clearly if the prices of Italian bonds are falling and they hold them, then that's going to hurt some of their returns. But more importantly than that, has this massively pushed back the chance of the ECB raising rates if there's an issue in the third biggest economy of the Eurozone? And if that's the case, banks in Europe haven't been able to make profits for years because yields are so low. And if we're not going to see rate rises now, again, you're having questions about their ability to get back to a decent profitable stance. And that's infecting banks globally.
Okay, so that's a good point, because then you look at the Federal Reserve here, which risks getting even more offsides to where the Europeans are in terms, Doc, of their rate momentum and the moves that could happen.
Right. You look at the June meeting that we're talking
Coming
about.
up, right? Few weeks.
Right in front of us, and now we have a 385-point sell-off. Not that one day is going to affect the complete Fed and their vote as to whether or not we move up rates, but nonetheless, the European banks, EUFN is an ETF that tracks those banks, and this thing is just decimated in the last few days.
Right.
It's accelerating to the downside. The yield on the Italian 10, as we all know, went from about 0.21 to 2.5% in 3 days. I mean, that's that kind of acceleration that when we talk about speed, that's speed, that Indy doesn't get up to.
Yeah, the Italian too. I mean, you saw what.
But putting the speed aside, where should it trade? If U.S. Treasury, if
Not at 2.5.
Why not? If a 10-year U.S. Treasury is 3%, is Italy a better credit?
Well, you're comparing 10 to 2, though.
The Italian 10 is 3.1 right now, or
right.
at its
That's
highest
the
level.
one that's off, not the 2.
But actually, that move was more tame. That was only about 43 basis points from low to high in the recent range. And so the question becomes, what? No, the 10-year. I'm talking about the 10-year yield.
I agree with you.
So where should that be priced? Italian debt to GDP is 130%. Did that fact sneak up on us, or are we all aware that there is A, chronic political volatility in Italy over the last 30 years, number one, and B, a very high debt to GDP in a not substantially growing economy?
Right.
Nobody should be surprised that yield is where it is now.
Italy has 11% unemployment rate. They have 1.4% GDP growth in the most recent quarter. Private investment, public investment, very weak across the board. Contrast that to in the U.S., where we're probably going to print a 3.5% GDP number in this quarter that we're in. Maybe it's not sustainable, but we're growing a lot more than where Italy is growing at. We have double-digit earnings. Revisions are going up by 9%, while multiples are down 7%. And oh, by the way, business investment was up 7%.
Okay, so you're painting a scenario in which this is why the U.S. is the best place to be.
My point is,
similar comments from El Arian this morning on Squawk.
Italy is trading where Italy is trading, and to the point of these guys, the reason why Italy's rates are where they are is because they're in a whole bunch of much bigger problems than where we are.
And they never belonged as low as they were in the first.
Whoa, stop. What is going on here? Well, what you're looking at is a plummeted price of AutoZone stock in just a matter of an hour or two, when it went up pre-market from 710 and fell later in the day all the way to 596. Why should you care? By utilizing a very simple option strategy, we were able to turn every $1,000 of investment from 9:30 in the morning till 10:45 a.m. into an excess of $10,000. That's right, literally a $10,000 investment produced in excess of $100,000 in gains. The crazy truth about stocks and options trading: most of the fortunes were created when stocks fall. So if you're not utilizing this crazy strategy, you're definitely missing out on thousands of dollars, and you're leaving that money on the table for somebody else. Look, these are the facts. Just think about it. Stocks drop actually much, much faster than it takes them to climb higher. So just take a look. There's your AZO graph right here. It took it a month, 2 months to get from this 580 level all the way to about 700. And look how fast it dropped just in one day. Now, how do we know that this had a potential to happen? Look, it has a history of doing these things at the same level at around 700. It did it last time during the earnings report. So you don't have to be a rocket science. You just got to know which stocks, when to take action, and you got to know how to find the stocks. Has it ever occurred to you that every day when the market goes higher, there's plenty of stocks that actually drop? Because if every day some stocks did not drop, then the market would go to the moon, just like Bitcoin, right? The reality of life, everything that goes up must come down. Look at the housing bubble in 2008. Bitcoin prices, when nobody believed, we put a recommendation at 18,800 to short Bitcoin. In other words, to make money when it falls. The bottom line is this: you don't need a market crash for you to actually profit on stocks falling. The opportunities are there every single day. You just got to know where to look for. If you grasp the simple idea that stocks fall much faster than they go up, you will be able to become a much more effective and efficient stock or options trader. Okay, hold on. So what you're saying is, while everybody's chasing the stocks on the way higher, the real money is actually made when stocks drop. Yes, that's exactly what I'm saying. If you'd like to learn more about this fascinating and yet such a simple strategy, I invite you to go behind the scenes with me, where I will reveal to you how I turned 12,000 into 466,000 in less than 7 hours trading options with this strategy. And I know this sounds crazy, but I actually did it. And I want to share with you all the specifics, all the details of how I was able to accomplish that. So if you'd like to become a better trader, take action now. Click the link on the button below. Life is too short. Don't waste another minute. Today is your day.